It's Brian Preston, the money guy.
We all want to have a whip that looks good when you're young because it's the reality. Is it you've been in college. Maybe you come from like we did, where my wife on our first date, she asked, it was kind of a setup date, and she asked her girlfriend, well, what color is his car?
Wait, what color was that car, Brian?
She said, well, it's kind of rusty because it literally was rusting away. I mean, I had what we called the Ragalier. It was a Chevy Cavalier that was so old, but it was one of those things. So I daydreamed about the day I graduated from college, got my first job. I couldn't wait to get the first car.
Yep.
And I'm telling you, this is the way everybody's wired.
Yep.
I need to reward myself for the great decisions that I've made by studying, being a good student. I deserve this.
Yep.
But guys, it has a cost, a huge cost, because what's the problem with cars? Bo, when you buy a car, what happens when you drive it off the parking lot?
It immediately loses value.
It doesn't matter if it's a new car, used car, these things are sinking in value every day.
Yep.
I mean, there's very few exceptions. You know, we could go back to the classic Mustangs, Camaros, Corvettes, but that's not what we're buying when we're 22 and 23 years old. We're buying usually the new used car, meaning new to us, or buying a brand new car. So what's the financial impact of that?
So let's talk about how much does it really cost. So if you've been listening to us for any period of time, you know that we think that there's a correct way that you ought to go about making your auto purchase. And we think you ought to follow 23-8.
23-8. I like the sound of that. Bo, walk them through what 23-8 means.
Quite simply, that means that when you buy a car, whether it's new or used, you're going to put 20% down. You are only going to finance it for 3 years or 36 months, and you're not going to let your payments exceed more than 8% of your monthly gross income. 23. Now, this only applies to regular brands. This is Toyotas and Hondas and fill in the blank. If you're someone who wants to buy a luxury car, 23-8 does not apply. In our opinion, if you want to buy a luxury car, you got to pay it off in 12 months. That's your time
So
frame.
if you're rewarding yourself with a BMW, Mercedes, Tesla, that's probably it needs to be paid almost like cash.
Yep.
But here's what I know from life, Bo. 23-8. That sounds great, but when you walk into the dealership or you do your first call for a purchase, they're going to say, what can you afford monthly? What's your monthly payment?
That's always the question that they ask.
We can get you in, why focus? Why do you want to have that car paid off in 3 years? Maybe instead of paying the car off in 3 years, let's focus on what your monthly payment is. Hey, and we have great banking relationships. We can actually finance this car for 7 years. So that way you can get into something just a little bit more comfortable, something that's a little safer, maybe has more technology in it. This is what we can do for you, is we can spread your payments, not 3 years, we can do 7 years. You ought to take advantage of this. This is a great opportunity for you. So that's how it's pitched.
That's exactly right. Hey, I love your 20 and I love your 8, but let's do the 7. Instead of doing 23-8, if you can afford that monthly payment, that 8% of your gross income, let's just stretch it over 7 years. And what you're going to be amazed by is that if you did that old money guy thing and you just did that 23-8, you could buy an $18,000 car.
And it's not lost on me that full-time equivalent Daniel, it's not a jalopy, but it's definitely not a sexy car. Kind of rolled in slowly. So you could actually qualify to buy a car that's around $18,000. That's
exactly right.
But when you got the slickster salesman. He's like, don't focus on what the debt is. We're not worried about the debt. We're worried about the payments. Payments is what you need to focus on. So they're going to get you to finance same payment, but over 7 years. What does that get you?
Well, then, if you're willing to do that,
whoa,
we can get you into a $40,000 car.
That's sexy.
That is sexy. And the beautiful part about this is they're both the exact same payment. $421 a month. You, car buyer, make the choice. Do you want the money guy jalopy or do you want the fast, sexy sports car?
So do y'all see how we've set this up to where, I mean, it really is. The monthly outflow is exactly the same. The difference is how long are you willing to pay? And even I think that I love what Daniel did on the pictures is because it is true. A $40,000 car looks so much cooler to your friends and family than that $18,000 car. Even on our slide, it looks a lot cooler. But guys, there's a cost. Huge opportunity cost. This is why I call this financial napalm, especially for young people, making these lifestyle decisions that really are the faking it until you make it. So let's kind of go ahead and walk them through. What does this do to your financial life in the long term?
And look, we want you guys to recognize we're not trying to paint the numbers here because we all know when we buy more expensive cars, the maintenance is higher, maybe the gas price is higher, the insurance is higher. We're not even factoring any of that in. We're only just factoring in how much you have to pay off the car. So our numbers are conservative. I just want to lay that out there because I think it's an important distinction to make. So both cars cost $421 a month, but the affordable car will be paid off 4 years earlier. So what if over that 4 years, instead of having to pay for the more expensive car, you just invested that $421 per month? Well, what happens is after that 4-year time period, you will have saved just over $20,000. So if this is a 30-year-old from 30 to 34, you will have saved just over $20,000. But if you let that savings continue to grow for you, now we're at 9% because we're in our 30s, by the age of 65, that $421 a month over 4 years will have turned into almost $400,000.
And by the way, we only did this for 4 years of opportunity costs. We know that's not the way it happens because we do this once with a car. Because here's what Daniel found out last time we did a full auto show. I was shocked to see how much the average American is financing toward cars. Daniel found out that close to $2,000 of that amount was actually negative equity, meaning that they owed more than the car was actually worth. No problem, because the auto industry has figured out a solution. They'll just roll it into the next loan. So once again, we're turning compounding interest upside down, so it's working against you. You never actually own anything in your life. You're just financing it out longer and longer. So this is going to be a bigger than a 4-year impact. This $400,000 impact is happening over and over and over again. So I'm thinking, once again, you said we're using very conservative assumptions, not taking into account the premium gas, not taking into account the maintenance and the insurance on the much more expensive cars. I think we're being conservative because we're making this mistake over and over again. The average American is not doing this right. Don't fall prey. Pay attention that cars are not investments. They are definitely expensive purchases that can derail your long-term financial life.
Now, I just think this is one just behavioral thing that I'll add in here. One of the things you've talked about all the time, Brian, is when you were young, in your 20s, you didn't go out and buy a fancy car. You didn't go buy the new, latest, and greatest car. Instead, you made the choice to defer that gratification until some point later in life. Now, hey, because I don't think you'll mind sharing this. Do you care if you tell everybody what kind of car you drive? Is that okay? Because I don't know if our audience
now or
knows.
when I was 22.
No, right now. Like the car.
I have a Tesla.
Oh, you drive a Tesla, right? I don't know if we all knew that.
Are you about to pick on me? This was not in the pre-show meeting.
How much more enjoyable is it now that you made that purchase decision at a stage in life when it wasn't something that had you eating, cat food hamburgers every night for dinner? You did it when you could actually afford it. It made the joy of owning that thing a lot sweeter than if you were trying to stretch to get by early on.
Well, no, we talk about hedonic treadmill all the time. That's why I always get nervous if you buy your kids too fancy of a car just because you can. And where
do they go from there?
Where's the celebration for themselves later? I mean, I like that I had a junky car all through high school, all through college, because when I bought that first Mazda, a used Mazda, thought it was the greatest car. It had the oscillating, it was a 626, had the oscillaling vents on it. Brilliant. Didn't have leather, didn't have anything else, but it was great.
But the vents oscillated.
Yeah, but think about all the journeys, because I haven't had a ton of cars. I went from the Mazda to an Acura, and then I bought the Lexus ES350 that my daughter still drives, by the way, because I've passed it down before I got the Tesla. Is that all those things kind of rolled in to where I did have a sense of fulfillment when I did it in the right order.